Welcome to Unit 4, the income statement. In Unit 4, students will demonstrate skills necessary to classify items as revenue or expense. They'll learn how to prepare an income statement. They'll be able to explain the time period principle and the matching principle. They'll use the accrual basis of accounting for revenue and expenses, and they'll be able to explain the cash basis of accounting. This unit is quite short. It'll only take 2 or 3 classes to complete, and you will have the Unit 4 test in approximately 3 classes. Let's take a look at the purpose of accounting. We've already discussed this in the past. The purpose is to use a system that will provide financial information that can be used to make decisions. Owners, managers, investors, bankers, the government can all use this information to help them make decisions. There's 2 types of accounting activities: recording the daily transactions and preparing reports that summarize those daily transactions. Up until now, we are very competent at recording daily transactions. We know how to prepare a balance sheet. Now we're going to take a look at an income statement. We're going to learn how and why we use an income statement. First of all, we have to talk about profit and loss and get the definitions of these. Profit is the increase in owner's equity that results from the successful operation of a business. You need to know this definition. Loss is the decrease in owner's equity that results from the less than successful operation of a business. Along with profit and loss, we have to take into consideration revenue and expenses. The definition of revenue is amounts earned from the sale of goods or services during the routine operation of a business. Please memorize this definition. Expenses are the costs of goods or services used up in the routine operation of a business, such as salaries expenses, advertising expenses, delivery expenses, and so on. How do we determine profit or loss? Let's take a look at an example. We have a television set that is selling for $500. The store that is selling this television set spent $400 to acquire the TV, advertise for the sale of the TV, and pay a salesperson to sell the TV. If we use the formula revenue minus expenses equals profit or loss, we can say that the $500 is the revenue, the value of the funds taken in when we sold the TV, and we subtract the costs associated with selling the TV, which in this case were $400, and we have a profit of $100. In accounting terms, revenue minus expenses equals net income or net loss. 500 minus 400 equals $100 net income. Let's take a look at the income statement itself. It presents the revenue, expenses, and net income or net loss for a specific period of time. Now this is really important right here. Period of time. What is the accounting period? That's the period of time that is covered by financial statements. Up until now, when we had balance sheets, we put a specific date. But now when we prepare income statements, we have to take into consideration the whole period, the accounting period. Another name for accounting period is fiscal period. You need to know this term. It's interchangeable with accounting period, and you'll hear about it a lot if you listen to television or radio reports. They quite often talk about fiscal period. So, what is the structure of the income statement? First of all, we have the heading. Just like the balance sheet, we ask who, what, and when. Then we have a section for revenue, Then we have another section for expenses, and that results in a net income or net loss. There are 4 steps in preparation of an income statement. The heading, the who is the business name, the what is the income statement, and the when is the accounting period. Once again, I want to emphasize, this is not a particular date, it is the period of time covered by these financial statements, or in other words, the accounting period. Here's an example. Goldman's Gym. That's the who. The what is the income statement. That's the document we're preparing. And here's the really important part. You must use these words. For the month ended, and then you put the date that this accounting period has ended. If you don't include for the month ended, you will lose marks on any of the tests or assignments that we do. Part 2. You prepare the revenue section first. So you have to have the title that is called revenue. Then you list each of the different revenue accounts. In this example here, we have member fees, tanning bed rental, and towel rentals. In the column next to that, you list the value of these accounts. The last thing that we do in the revenue section is to total up all the revenue. So we use the title Total Revenue. The total goes in the next column to the right of where each individual account value is. And because it's at the top, we put a dollar sign. It's at the top of this column. It's the first item entered. Don't forget to put the single line to indicate that addition and subtraction is going to occur. Even though it's in the line or in the column adjacent, we still need to have this line right here. Next, step 3, we prepare the expenses section. We have the title for the expenses called expenses. Then we list the accounts that are part of the expenses, and in the next column we list their amounts. The first item in this section needs to have a dollar sign. At the bottom of the expenses section, we put the total expenses and its amount. Now, because we had an amount total for the revenue, we don't need a dollar sign here for the total expenses. Once again, we have to have a single underline to indicate addition is occurring, and we put the total in the next adjacent column. Then we determine the net income or the net loss. We take the value of the revenue and we subtract the value of the expenses, and this gives us our net income. If the revenue is greater than the expenses, it's net income. If the total of the expenses is greater than the revenue, we will have a net loss. Speaking of net loss, let's talk about net income and net loss. Net income is the difference between revenue and expenses when revenue is greater than expenses. Net loss is the difference between revenue and expenses when expenses are greater than revenue. Please notice the difference. Revenue is greater if we have net income. Expenses are greater if we have a net loss. Let's take a little test to see if we understand the idea of net income and net loss. In example A, we have $100,000 in revenue, $70,000 in expenses. What would the net income or net loss be? That's right, $30,000 net income. The next one, $20,000 revenue and $19,500 in expenses. The net income, $500. The next example, we have revenue of $31,000, and this time we have expenses that's greater. It's $35,000. So, do we have a net income or a net loss? Because the expenses are greater, we have a net loss. Please notice, when we have a net loss, we surround the number with parentheses. Part D, 14,000 revenue, 11,000 expenses. That's a $3,000 net income. Last one, 28,000 revenue, 30,000 expenses. That results in a $2,000 net loss. Once again, notice the parentheses. When revenue is greater than expenses, there is net income. When expenses are greater than revenue, there is net loss. Your assignment for today is to complete questions 1 to 7 on page 73 in your textbook, and you can answer these on the Accounting 11 website, and do exercises 1 to 3 on page 73 and 74, and those answers can be done in your workbook.